9%. This is versus 8.2% last quarter. So it's a big beat as far as the EBIT margins in the oil to chemicals business goes. And the core EBITDA for the oil to chemicals business has come in at 14,194 crores. This is also a big jump compared to what we saw last quarter. In fact, let's get in Probal Sen, who's the energy analyst at ICICI Securities. Probal, looks like a big beat on the numbers this time around. The core profitability is the highest ever that Reliance has reported at 19,299 crores, which is a growth of 22% compared to what we saw last quarter. So a big beat in the numbers. But you tell us, how have you read into the oil to chemicals business?
Well, I think the numbers are actually, if I look at the EBITDA number, you mentioned 38,000 odd crores, which is broadly in line with what we were looking at. On the net profit line, there is a small beat, yes. We were at about 18,800 crores odd in our estimates, and the numbers have come in ahead of that. So, and primarily it does look like the OTC segment, where we were looking at about just shy of 16,000 crore of EBITDA, whereas the EBITDA that seems to be coming through is a bit ahead of that. So definitely a very strong performance from the OTC segment. Primarily, our sense is it is led by, very stronger GRMs and, a relatively lower impact of the windfall tax in this quarter. Another impact could be that, the higher extent of Russian crude that has been coming into the system for all Indian players. That price benefit could also have helped, the refining business to a certain extent. We obviously don't have the exact number in terms of how much percentage of crude was from Russia and what price benefit played out. But the numbers and the strength in those does seem to indicate that on the costs front, that would have played a role. So on the whole, I think a fairly strong set of numbers. Geo is not that much of a surprise, really. I think it was expected to be flattish on a QOQ basis, which is what has come through. And as your colleague was mentioning, the retail strength based on the revenue increase that has been achieved is also, I think, something that is definitely a bit of positive surprise. Retail is definitely far ahead of what we were looking at. So yeah, pretty decent set of numbers coming through, and obviously FY23 turns out to be another record year to that extent.
Right. On the telecom business, Reliance Jio, there's really no surprise. In fact, it's been a steady and a bit modest in terms of a performance, but something that the street was anticipating because there was no price hike which would have boosted the numbers. So revenue growth, 1.7% quarter on quarter. This has been driven by a 1.4% increase in the subscriber base. So the subscriber addition stands at 6.4 million in Q4, and it stands at 29 million for the full year. The Jio broadband continues to see strong additions of close to about 9 million subscribers. So revenue growth 1.7%, margins absolutely flat at 52.2%, PAT up 1.7%, awaiting the ARPU numbers, but Reliance Jio looks steady.
Okay, steady.
Yeah, just on the retail business, while the revenue has been resilient, what's really standing out this time around is the way the operational performance of the retail business has taken place. Up until a couple of quarters ago, we would wonder whether the retail business, which is a valuation driver, will continue to be just a revenue driver, or at some point operating leverage will come by as well. And this time around, it has happened. While the revenues have grown by about 2.5%, the EBIT has grown by 3% quarter on quarter. Even year on year, the estimates of the growth on the EBITDA for the retail business was close to around 30%. It's grown upwards of 32%. So it's a formidable beat on a high base. So that's a big positive. The fact that the operational performance of the retail business is now beginning to kick in.
Okay, in fact, just wanted to get Prakash Diwan into this discussion as well. I was just looking at some more numbers. The oil to chemicals, the OTC EBITDA really stands out. 14,818 is the OTC EBITDA. That compares to about 12,109. So it's a big move that we're seeing on the EBITDA front. Just wanted to get Prakash Diwan into this discussion as well. Prakash, any thoughts on the overall numbers? I mean, this is the highest ever quarterly profits that the company has reported, just under 20,000 crores. But the stock has not performed as much. I mean, it's down about 7% this year. Is there anything in these earnings which could get the stock, ablaze, perhaps get it, back to its earlier highs?
So, Sonia, let me address the stock issue first, and then come to the numbers. The stock has been languishing more because of the fact that there's a lot of, new businesses that are seeing investments happen, and even the 5G rollout has been fairly intensive in terms of capital allocation. So while retail and, the core refining, the O2C business may not be capital hungry, but these new businesses tend to kind of take the balance sheet into a little bit of a lopsided, view where you may have to wait for things to start paying off. And that's precisely the reason why everybody keeps on looking at that as optionalities, which will at some point, maybe in the next 18, 24 months, start kicking. And then there'll be a very sharp surge in the expectation of valuation for the stock. And of course, the financial services, I shouldn't forget that, because that's already something that come May, we will actually see it getting operational. Okay. But these numbers give you a very, very strong, reference point. And Mangalam probably may recall that last quarter we had discussed that retail is going to be the next big growth engine. So, all this while they've been investing into new brand acquisitions, store expansion, different formats. Now what has happened, even the Big Bazaar, acquisition has been completely digested and manifested into the regular business. Now it's time for them to start looking at profitable growth and revenues. It's not just an investment phase, but it's the harnessing of all that expansion that they've done. So if this continues for 2 or 3 more quarters, Sonia, you can imagine how quickly retail will start adding so much of a punch to the entire P&L. So while O2C was expected to do well, it has, of course, done well. And as Prabal explained, there was very clear vectors to support that, including refining margins, including cost optimization, and the bulk of the regulatory impact of all those fuel costs that the government had levied. Those, the cess and all, that was in the previous quarter, not so much for this quarter. So all put together, I think it just makes it more attractive for long-term investors to buy. But we are in an environment where FIs have been selling, ETFs have been exiting, and that's why the stock remains under some sort of pressure. But I think it's absolutely on its way to that 3,000 plus mark in the next 12 months, given this performance.
So on Monday, are you a buyer?
I would be recommending this at every dip, Bangla, for sure. And typically, post results, the stock tends to be a bit soft. This time, it's not gone into earnings with very high expectations or high price action. But on dips, it's definitely a buy, whether it's Monday or the week. I mean, throughout the week, it definitely makes a lot of sense to add at lower levels.
Okay. Prabal, I just had a question for you on the oil and gas business, because this time around, while of course there has been a big jump on a YY basis, gas prices, they were stable on a quarter-on-quarter basis. So that has been the case. But going forward, since this is also going to be a big driver in terms of earnings, what are you penciling in here?
So for the oil and gas business, the recent changes obviously don't really matter to Reliance that much, because the gas price ceiling, which is what is applicable to their gas production, continues to be at a fairly high level. And, so that price, will continue to drive fortunes. Add to that the fact that they've recently held another round of auctions for a further 6 MMSCMD of output. And there's probably another 6 MMSCMD of output that is expected by the second half of the year. So to that extent, we would expect that, EBITDA from this segment will continue to grow very, very strongly. Our sense is that E&P would probably end this year, would have ended this year. I'm yet to look at the numbers in detail, somewhere around 13,000 to 14,000 crores. And we would expect that number to grow to somewhere around 22,000 crores when the full 30 MMSCMD of production is online and, producing and being sold by RIL. So to that extent, I think even this segment should continue to grow in prominence for Reliance.
Okay. By the way, there's also the year-ended data, right, that's come out, the consolidated results for the full year. And some of these stats are looking pretty good. So it's a record annual consolidated profit after tax at about 74,088 crores, a record quarterly consolidated EBITDA as well that the company has reported. And Reliance Retail has recorded accelerated store openings with over 3,300 new stores, taking the total area to about 65.6 million square feet. So it's a pretty strong performance that you've seen in the overall business, not just in this quarter, but in the full year. led by the O2C business, and of course they've optimized feedstock costs and supportive product margins as well. So just reading out of the press release. But Dipan Mehta is also joining in. Dipan, these numbers are looking much better than what the street was estimating, record quarterly profits. But as we were discussing earlier, right, the stock's performance has been suboptimal. Do you think there is anything in these numbers which can cause EPS upgrades, or do you expect the stock to move higher from here post these earnings?
Yeah, Sonia, I think the numbers are very good and they're marginally better than what the street was expecting. But to move a stock like Reliance, you really need a very big trigger, and 7-8% type of a net profit growth, which is just broadly in line, is not going to really move the needle that much. End of the day, we are buying into 3 companies when you buy 1 share of Reliance. And in my opinion, the biggest trigger is the value unlocking opportunity and how that is going to take place. And if Jio Finance is any indication, and if they decide to split the company into 3, which I think is a lot of the expectation and kind of a request from the street, if that is taking place, then that would be really a big trigger. Because when I'm buying Reliance, I am forced to buy other businesses which like the O2C or the telecom business, which I may not be interested in. I like to buy the retail business, but that's not available just now. But nonetheless, I think it is a good set of numbers. And maybe one slight bit of concern is the rising interest cost. That is the net interest cost which the company has to pay. So clearly, I think debt levels are going up. And in an environment where interest rates are rising, one just needs to keep a little bit of an eye on it and what kind of an impact it may have on the operations of the company. So if you look at the EBITDA, the growth in the EBITDA, the growth in the EBIT, and the growth in net profit, the growth in the net profit is the lowest because of higher depreciation costs and higher interest costs.
Okay, just some more internals on the telecom business. Now, we typically end up looking at the telecom business, that's Reliance Jio. But Reliance Jio is housed under Jio Platforms Limited, JPL, which gets 90% of its revenues from telecom, but it also houses other digital assets of the company. For instance, Jio TV, Jio Cinema, and others. And JPL has clocked in a revenue run rate of 1 lakh crore in this quarter. 1 lakh crore is the annualized revenue run rate for JPL. So whenever it goes in for the demerger, which as Dipan was saying is the ask from the street, we're looking at a very big company. JPL's annualized revenue run rate has now hit 1 lakh crore. And it's not just telecom, even the other digital assets, like for instance IPL, which got streamed on the Jio platform, saw unprecedented viewership with a peak concurrency of 24 million. And the press release also goes on to say that the company is on track to achieve a pan-India 5G rollout by December 2023. So purely while Reliance Jio's telecom numbers are in line, there is no positive surprise. And it's just a growth of 1.7%, which in a way is slowing down, because in the prior quarter, the revenue growth was 2%. In the September quarter, it was nearly 3%. In the June quarter, it was 4.5% plus. So revenue growth has slowed down for the company in the absence of a tariff hike. These are inline set of numbers, no positive surprise. But the other digital assets of the company are actually growing very rapidly and seeing a lot of consumer interest. Dipan, any thoughts on Reliance Jio? I know there are no fireworks in the numbers this time, but how would the investors read Jio's performance?
I think better than what we were expecting per se, because it was expected to be a flattish kind of a number, but we have seen some marginal growth over there. And yet I think the company remains in that market share momentum game, and they're not yet focusing on improving the yields. At some point of time, I think they will reach a situation where there's only so much revenue that you can grow by adding more and more subscribers. And then at that point of time, I think growth has to come from higher yields. And that can be a really a very positive effect, because the Jio platforms and the telecom business is a high operating leverage business. So even marginal increases in the yields can have a disproportionate positive impact on the bottom line of the company. And more importantly, I think it will improve the return ratios. I think one of the big concerns with all of the Reliance divisions at this point of time is that the return ratios are on the lower side. And yes, of course, they are in investment mode, which is why we are seeing these kind of low return ratios. But at some point of time, I think we'd like to see higher return ratios as well. And that can happen only when the yields start to move up in the telecom business. And in the retail business, they try and kind of, the cost structure and the entire network stabilizes, and the growth of the actual rollout of new stores, that kind of stabilizes, and then we have better occupancy and better yields from the existing stores.
You know, you spoke about the retail business and the yields, etc. Dipan, I was just looking at some of the numbers, the kind of area that they've added. Quarter on quarter, it's almost 5 million square feet. Year on year, of course, from 41.6 million square feet, it's gone up to 65.6 million square feet. We've seen footfalls of 219 million across all platforms or formats, which is basically 22 crore people. Roughly 1 in every 7 Indians has visited a Reliance retail store. 966 new stores added in the last quarter. For the last one whole year, they've added 3,300 new stores. These numbers are, I mean, beyond mind-boggling. How much more do you think
Astonishing,
there's room for growth? 65.6 million is the overall area under which they operate. And 1 in 7 Indians going to a Reliance retail store in just one quarter. How do you put any number to this, phenomenon?
Mangalam, this is Reliance at its best when it comes to execution. I think that's one of the key strengths of the company right from its inception decades ago, that whenever they take up a project, they execute it beautifully within time and within the cost, and they try and get the maximum out of the assets which they have created. That is how they have created the Jamnagar refinery, the Telecom rollout, and now they are playing those same kind of strategies and systems and their entire advantages to rolling out a very strong retail network. And they know that this is where the opportunities are, and the competition over here is going to be in a way disadvantaged because of the size and the kind of muscle power that Reliance can put into the business. It's a great opportunity. We are seeing that a lot of retail is going from the unorganized to the organized, and this is the kind of a once in a lifetime kind of an opportunity which they are trying to grab with both hands. So I think that this is perfectly in line, and maybe they are a bit ahead of their plans as well.
Okay. Prabal, I wanted to come to you because this time around, of course, we are talking about higher refining margins, which led to this beat that we are seeing on the oil to chemicals business. What's happening on the petchem side? Have those spreads bottomed out? How is the demand looking? And do you think in Q1, both these segments together will contribute?
In fact, what has happened really is that refining margins, as you would have seen, have actually hit a multi-month low in the first quarter in the last couple of weeks. Part of it is driven, of course, by the fact that, the sudden price increase that happened in crude was yet to adjust in product spread. And post that, the slump that has happened in crude because of economic worry has reflected in GRMs as well. So petrochemical, you're right, that spreads, after having hit pretty much a bottom, I think probably about 2 quarters ago, have been steadily improving, though they are still far off from their historical averages. Our sense is that integrated margins are still below $500 a ton, whereas the long-term average is closer to 600, 650 odd. So to that extent, there is scope for further improvement as and when global demand improves. But on the refining front, I think the near-term, signals have been fairly negative. One clear signal would be when Chinese demand really starts to recover, hopefully by the second half, and one has some visibility of whether there is a recession of any sort that can come in the US, then the refining demand balance can maybe tighten a bit. But I think in the first quarter, the signs are actually a bit weaker than what we have seen in the fourth quarter for the OTC margins.
In fact, the management in the press release states that the O2C segment has posted its highest ever operating profit despite all the global uncertainties and despite the disruptions in the commodity trade flows. Now the oil and gas segment has not only delivered very strong growth, but is poised to contribute nearly 30% of India's domestic gas production. And this is despite all the global uncertainties. So, Prakash Diwan, I wanted your thoughts here. The O2C business is firing on all cylinders. In fact, from single-digit margins of, I think, 9.5% last quarter, margins have already jumped to about almost 13%. Do you see more scope, more operational improvement in the O2C segment? And if yes, is that something that you have factored into the stock price already? Or do you think there could be more upside because of the growth here?
So Sonia, the O2C business has an element of gas pricing, which probably is not yet completely discounted or factored in terms of what estimates most people would have. And the petchem business is something which probably is the one that's gone into a steady state on both revenue and margins. But refining will, of course, continue to have its own share of ups and downs given global geopolitical situations and all. But my sense is that the more E&P work that comes through on the gas side means that you will start seeing expansion, and that is something which could definitely lead to operating leverage. I mean, you've seen peak margins of the business when it was much smaller used to be in that zone of 14.7. Now that is something which could happen on a revenue which is almost like 3.5-4x of what it used to be. So that is something which I think the market will start rewarding the company or the stock for at some point in time, when Geo and retail and all don't eclipse all the things. O2C is the core business; it's the oldest business, but all of us were only tracking that, and now have learned how to track the other two businesses. But the essential part is that if that were to fire, it becomes a very strong base for the capital-intensive nature of other businesses to be sustained. And as Deepan was saying, the interest cost is something which you need to keep a close watch on, because if you have decent cash flows, you can start kind of getting out of the debt cycle at a faster pace and have a lesser financial impact on that. So the OTC business will do well and will definitely have much better effects, second-order effects on the overall P&L. But I don't think it's factored into the stock. I mean, I always feel the stock is undervalued given so many other vectors, but this time O2C is definitely something which will have to be looked at seriously in the valuation.
Okay, so while we are talking about O2C, one of the other segments that I've been tracking for last couple of quarters, because KG D6 production that has started for Reliance Industries in terms of gas production, and they say that by FY24 this particular basin will be able to produce 30 MMSCMD of gas, and that is what Probal was telling us as well, that on an annual basis this particular segment has done EBITDA of around 13,000 crore rupees, and your estimate was right, Probal, and they expect it to go as high as 20,000 crore rupees once this particular production comes in place as well. This year they have done gas production of around 20 MMSCMD. By FY24 it will be around 30 MMSCMD. So just to give you some perspective, India consumes gas out of which 50% is domestically produced, and Reliance Industries will be able to make 30% of that domestically produced gas. So that's the big amount that we are talking about here, and that could be the next big trigger in terms of earnings coming in for Reliance Industries itself. But yes, this is largely what we are talking about, oil to chemicals and oil and gas business, both of them doing really well this quarter. Okay, well, any final thoughts? Deepan, I wanted your thoughts, just to summarize for our viewers who've perhaps joined in. Reliance Industries earnings much better than what the street was estimating, a beat on all parameters, highest ever quarterly profits that the company has reported, led largely by the oil to chemical business, which has seen an EBITDA growth of almost 17% compared to last quarter. The consumer facing businesses have also done quite well. Both Reliance Jio and retail have had a resilient performance. Deepan, last word from your end for Reliance shareholders. What does this mean on Monday?
Well, I think that we entered into this particular Reliance earnings on a very low key, and there were hardly any expectations. And whether the company coming out of these kind of numbers, I think it's definitely a bit of a positive surprise. You could expect a mild up move on Monday when when trading resumes. And I think a lot of focus will go into some of the other new age businesses, because that's where I think the maximum interest is from investors. And we'll be doing more and more analysis on the retail business and the Geo platform business and seeing what their plans are going ahead.
Okay, gentlemen, thanks a lot for joining in and helping us analyze these numbers, and thanks to my entire team here as well. Just to wrap up for all our viewers, good numbers coming in from Reliance Industries, a beat above street expectations, better on all parameters actually. Oil to chemicals business has seen record profits, highest ever quarterly net profits for the overall business as well. EBITDA margins have improved on a consolidated basis to 18% versus 16.2% last quarter. And for the full year, the oil to chemical business has posted its highest ever operating profit despite all the global uncertainties and disruptions in the commodity market. Reliance Retail, as Mangalam was telling us, resilient performance, revenue growth of 2.5% quarter-on-quarter, and year-on-year growth is led by a favourable base. And RIL Jio has also reported a steady performance this time around. The average revenue per user on a year-on-year basis has gone up almost 7% and 0.3% increase in ARPUs on a sequential basis. Thanks a lot for watching this special coverage. We'll take a quick break and be back.